Trevor can't. Hi, Trevor, if you're watching this, can't make it. So he's kind enough to video tape us today. So by now, I'm just trying to think. Everyone's got the book, textbook. I know one or two people. You have it look. Okay.
Yeah.
John, you got yours? Okay. Just want to make sure. Okay. Let's bring ourselves up to date on what we've covered and what we're covering. And everyone has RIA password. Okay. And my recommendation, if you get a chance, make sure, try to spend 10-15 minutes on it daily. It will serve you well. And then if you have questions as you're using it, let me know. It is truly one of the best tools any of us can have. I use it regularly. Comes up in so many different ways in how I use it. So they also have a daily tax newsletter too that I find very useful about what's going on down in DC. So in terms of material, we have the introduction, talks about our situation with respect to the tax system, and then chapter 1 with the notion of what is authority. We are always constantly looking at sources of authority, and we know when it comes to sources of authority and how we as professionals are treated, we have that threefold sources of authority. We have Circular 230, we have state regulatory agencies like the AICPA and the State Licensing Board, and third, we have federal statute. Federal statute, again, Circular 230 is a product of a different part of the, it's not part of the Internal Revenue Code. Remember that Circular 230 is just regulations pertaining to how the Treasury Department should operate. Title 26 deals with the Internal Revenue Code, and we're regulated there under the Internal Revenue Code as practitioners, primarily, not exclusively, through Code Section 6694. So the authors in chapter 2 talks about tax return preparation and advice, and we spoke about taxpayers first, and then tax return preparers second. And so far as taxpayers are concerned, just summarize the penalties. Brian, what are the penalties? And Omari, if you can, anything that Brian left off, you fill in the gap. So just summarize, Brian, what are the penalties? Your client's talking to you. What kind of penalties does that perspective, that client have, potentially?
Late payment penalty.
And just tell us how much it is. And anyone wants to chime in, feel free to.
0.5% per month.
Okay.
There's the late filing fee, which is 5% per month.
Okay.
Accuracy-related penalties, which is 25% of the underpayment.
So what is the penalty? I apologize.
25%.
20%. Accuracy, okay. Good mistake to make today, but again, the first two penalties you mentioned have a maximum amount of 25%, right? The accuracy-related penalty, repeat, is 20%, right? Okay. What triggers an accuracy-related penalty?
I'm not sure.
So understated value.
Say again?
Understated income.
Understated, and is it by $1 do you get hit with the penalty? John, do you get?
Percentage.
How do you know if you're going to get hit with an accuracy-related penalty?
10,000.
10,000 or?
2,000 and the 20% of the gross income.
So what's the, now remember, the accuracy-related penalty comes in several different flavors, right? There's not just one foot fault. You can be negligent, you can be reckless, you could have what's called a substantial understatement, right? And where is substantial understatement defined, guys?
Section
66, 62, what?
B.
Okay, let's look at it together. Because this one is very, what do we say, comes up a lot. And it's known as the no fault, right, penalty. It is in 66, 62B2, but we need a little bit more flesh to those bones. So where would you look for the flesh? Let's go to the statute first. Mike, do you know where? Okay.
62-4.
Or before we get into the regulations, always try to go to the statute before the regulations, right? Statute always gonna speak the word of God. Look, 66, 62D.
Before I do it.
Yeah, sorry.
I'm sorry.
I beat you to it, or I said it louder.
I got it D, but.
Okay. D. It's the greater of $10,000 or 5,000, right? The greater of the two. All right. Right, are those the only penalties?
There's a fraud penalty also.
How much is that? Or what percent?
75% of the understatement.
75%, right? Any other penalties, John, you were gonna say?
Well, I actually have a question. So if the understatement's less than those amounts, then you would not get hit with the penalty, I guess?
That's a good statement. So John says if the delinquency is less than those amounts, would we not be potentially subject to the penalty, right? Ming, and you say yes or no? You're not sure because you, Dixie? John? You gotta say it louder.
Interest, but not a penalty.
So you say, interest is always a factor, right?
Right.
Anytime you pay late, your client has, potential risk of bearing interest. But the question is, if you don't have a substantial understatement, does that mean implicit in that you don't have a penalty under 66, 62?
I guess it depends.
Depends.
Yeah.
That's right.
If it's every year you do the same thing, it's like probably is offense. You have a common, it's not a one time.
Well, let's put it this way.
Reasonable cause.
Remember that, well, hold on, reasonable, don't muddy the waters, because first you have to see if the penalty imposition is proper before you get into whether or not there's a reasonable cause as a defense, right? Because if you conflate the two concepts, that's not how it goes, right? First, determine liability. If there is liability, then determine if there's reasonable cause under 6664, right? Because you don't see the word reasonable cause buried in 6662. But John's question is, and I think, John, you can answer this question yourself. Why? Because if you turn to code section 6662, which I don't know why I turned away from code section 6662, but if you look at it, it deals with, which is attributable to one or more of the following. So if you look at just the statutory language of 6662, it strongly suggests that any one of these. So even if you don't have a substantial understatement, but you're negligent, you can be subject to the penalty.
Okay.
So one takes a mindset, right? Negligent takes that you're not thinking straight or you're being reckless, where the substantial understatement penalty is just the magnitude is such, you should have been more cognizant of what you were doing. Right, so just know that. Okay. And I just want to point out, Brian, for your records, for everyone in this room, that you have to, in my opinion, yes, you should know these penalty amounts as practitioners, we should all know. And we should, and they haven't changed for many, many years. I don't think they will change for many, many years, okay? So these are things you really should commit to memory, because clients will often ask you, what are the consequences associated with their delinquencies? And by their delinquencies, they may say they want to hold you accountable. So,
I think John's answer is in section 6664, reasonable cause exception for underpayment.
there is.
Yeah.
There is an exception. You're absolutely right, that once you determine that there may be liability, then you look to code section 6664 for reasonable cause, and see if you can help your client. But I was just gonna point out that once you go through and make sure you understand all these penalties, you should also cap it off to put the fear of God in your clients, that saying there's criminal liability, potential criminal liability, you know, if they are also over the top aggressive. So, you can point that out. Like if we look, I think your code book has it at 7201, let's see if I get that right. So you said, yeah, whole bunch of, and we're just getting a small taste of it, different criminal statutes. And just to make sure us practitioners can lose some sleep. If you look at 72062, any person who aids or assists, and guess who fits that bill? People like us, right? Because if we aid or assist our clients in perpetuating tax fraud, we have a big risk, right? So these are the kind of things, guys, all of us, including myself, have to know. Now, what are the standards taxpayers are supposed to have or meet with respect to preparing their returns? In other words, for completing tax returns for taxpayers, not for tax return preparers, and like I said, for exams, make sure you can distinguish between the two. Taxpayers are supposed to meet what threshold? Or, Viva, you were alluding to it before, for reasonable cause. What were you just referring to under 6664?
C.
Okay, 60C, right? And how do you avoid the underpayment penalty? If it was shown if they had reasonable cause, okay, if they had reasonable cause and the taxpayer acted in good faith,
No penalty.
there's no penalty. But just keep in mind that to avoid the 60s, like there's some penalties you can't, if you file late or you don't file a return, There's no reasonable cause. This is only with respect to the accuracy related penalty, right, guys? And to avoid the penalty, John, with respect to substantial understatement, what do you need? To avoid the penalty associated with a substantial understatement. Because, do bear in mind, right, that's gonna be a very common penalty. How do you avoid that penalty, guys, with respect to a substantial understatement? Anyone wanna say again, Meg?
Adequate disclosure.
Disclosure.
Yeah.
Okay, you could make, as long as there's a reasonable basis, you make disclosure. That's one way of avoiding the penalty. What's another way?
Substantial authority.
Substantial authority. Where am I looking? I am looking at 6662 D2B. Everyone have that? 6662 D2B. We give you two methodologies to avoid this penalty. Everyone see that in their code? Now, I just want to call to your attention. Can you make disclosure and avoid the penalty with respect to tax shelters? The answer is no. Everyone agree? And it specifically says that. If you look at C, right? 6662 D, D2C. Reduction does not apply to tax shelters. So, how does a taxpayer avoid penalties with respect to a tax shelter?
More likely than not.
Okay? Can I just hand this out, V? And if you say that, V, where's your authority for saying that? Aside from the fact that I may have mentioned that. So, don't cite to me.
Reasonable statements don't rank.
Jay Solid saying that you will not find that anywhere. You will find that in the dustbin.
It's in the regulation.
It is in the regulations, which I'm distributing.
Oh, okay.
Do you know where does your,
1.6662-3B3.
I mean, you should find it in 6662-4G, which is what I'm handing out right now. Sorry, Kevin. Relating to a tax shelter. Non-corporate taxpayers, which is, last I checked, us. Tax shelter items, which we saw are defined of a taxpayer, other than a corporation, are treated for purposes of this section as if such items were properly shown on the return for taxable year, computing the amount of tax shown on the return, and thus tax attributable to such items is not includable in the understatement if these conjunctive, both conditions have to be met. There has to be substantial authority for the tax treatment, and taxpayer reasonably believed that at the time the return was filed that the tax treatment, and it was more likely than not the proper treatment.
And what regulation is this?
This is 6662-4G. I just copied and pasted. Printed it out. So I'm just letting you know, if you're wondering, which is a good question. I will share with you, I am beginning a new case in my office as an expert witness. So I started reading this big binder yesterday. And in this class is very relevant because the taxpayer got hit with penalties. But I will share with you that this taxpayer was an executive who got bonus options in the year 2000. How much do you think these, and they were taxable as ordinary income. So I'm just reading along because I'm trying to figure out why they're hiring me, a guy from New Jersey, and this case is happening in California. I know how they got my name because a friend of mine is out in California and he can't take the case, so he was kind enough to, but I'm like, it doesn't make logistical sense because Solid, New Jersey, case California, if I have to be deposed, I'm gonna have to fly out to California. Like the numbers don't seem to make sense. So, and very focused, the taxpayer invested in a tax shelter, okay? But just to show you my Friday afternoon, how much do you think he made in options in the year 2000? So in the year 2000, guys, right, time value money, it's probably double today, 18, 19 years later. Give me a number. What do you think as I'm reading along I see he made in the year?
2,000.
How much?
I mean, no, you're asking how much did he make in the
Yeah,
year 2000?
this corporate executive,
$1 million?
5 million.
Yeah.
Up the ante. Keep going, guys.
Oh, shit.
500 million?
How much?
500 million?
Oh, wait, we're talking private sector, like 100 million?
How much?
100 million?
I had to actually look at the zeros twice. He made $250 million. Now, obviously, that wasn't enough because if you make $250 million and you have to pay the government 40% of that, you're only left with $150, and that just doesn't cover your bills. So you have to find a tax shelter, right, to invest in so that you can take home the full $250 as
I guess
opposed.
he lost all this money though about 2 years later because the market went south.
I can't answer that question.
That must be a big corporation, 250 million in bonus option?
All I'm saying is, I kept looking at the zeros and saying, am I looking at this right? Because I don't see numbers like that too often, guys. That's $250 million, okay? And that was 19 years ago, so that's like $500 million. And I don't understand the psychology where, where you say, I gotta find a tax shelter for that. Like, your ship came in, even if you get 60% of that, and then you have your own for the next, just think about this. This litigation is cresting. Have a good weekend, Janet. This litigation is, I'm not saying I haven't met the taxpayer. For the last 19 years, he's had to deal with it in some form or effect. Like, when you have that kind of money, don't you want to just go out there and look at butterflies and enjoy nature and things like that, as opposed to having to deal with the trials and tribulations of litigation? My point is, these tax shelters, taxpayers, in fairness to this taxpayer, without going into the names, this is public. BDO Seidman, some of you, no one here works for BDO Seidman, right? I mean, these are big accounting firms, one of the biggest law firms in the country, all gave their imprimatur that this was a legitimate tax shelter. So, it's certainly a mixed message about but could it meet these standards, right? That's the issue. Could it meet these standards, all right? So, guys, as we're going through, and you're thinking about, and so I did a little mathematics, and Brian, what was the potential tax penalty? Assuming the tax rate was 40%, what was the tax penalty the taxpayer had to endure here?
25.
Or just give me a numerical amount. If the taxpayer makes $250 million, what kind of penalties are we looking at here?
25%?
Numerically, because we got to see if it's worth dragging Solid out of California. So just do some.
So in the neighborhood of like
25 million.
20 million?
What is the penalty? Compute the penalty.
40%.
If the tax rate's 40%, what's the penalty amount on this? Just do some calculations,
So the taxes are 100 million.
right?
Oh, and what percent is the penalty? Is it 25% or 40%?
40%.
40%, so 40% of 100 million is 40 million.
Okay. Remember the penalty, right, Brian? Goes, if there's no economic substance, it goes from 20% up to 40%, right? Truth be told, the penalty, probably at the time, they did not have that provision because Code Section 77010, which deals with economic substance, is about a 2010 vintage, so the additional penalty of 20%, from 20% to 40%, which is now in the code, probably, I don't think in the year 2000 was applicable. So probably looking at a $20 million penalty, plus interest and things like that.
That's gonna be for $50 million in interest at this point.
See, what happened is, the taxpayer paid several years ago,
Ah.
and now is suing for malpractice. That's what this is all about. So now, it's a malpractice action. All right, but, that's what's going on. Everyone should keep in mind that when clients ask you, what kind of exposure they have, you gotta quickly come up with some numbers. If you don't report this or you take aggressive deductions, these are your penalties, right? It's very useful for clients, useful for you.
So which side are you the witness for?
I am for the plaintiff suing the, I'm very careful. I've turned down lots of cases in my life because I don't like suing professionals, just do not at all. But I also, on the other hand, don't like professionals who are completely over the top. And these people sold their souls to make money, to really rip off the government, in my opinion. So I have turned down lots of cases against professionals, but these cases, I think these were really egregious on the part of the professionals. So that's where I'm at. So over the next few weeks, I gotta go through this binder and the date for deposition has been set. I'm hoping that this can settle. Virtually every case I've worked on so far, they've settled ultimately. I've been deposed on many occasions, but never had to physically go. So I'm hoping, the only difference is in this one, the deposition, just to make it harder, we're gonna, I'm sure, say I can't be deposed remotely and they're not gonna come out here, so I may be stuck. There's worse places to go in California, but
Not much of a worse place to be though in California for all the tax penalties it goes probably.
yeah, that's true. Okay, so, in the weeks to come, guys, just make sure that you really know these penalties applicable to taxpayers. We're gonna move on, and we're talking about those penalties which are applicable to tax return preparers, right? And there's many, just like there's many penalties we see with respect to 66, 62 is not one alone, there's several. There's several that apply to tax return preparers and those who appraise return. There's 6694 if you're not accurate, but there's 6695 if you don't sign your return and things like that. And we have to know who's assigning and who's a non-signing tax return preparer. We went through some of those things last class, and I believe we ended right before class ended on page 64. And what we're gonna do throughout the rest of today is really hone in on what kind of exposure we as tax practitioners have when we prepare returns. So correct me if I'm wrong, your notes end off on page 64? Right, problem 2-6. By the way, I just will also foreshadow that on Wednesday, we have a guest speaker who I think is one of the best in the field. Going to talk about issues for our clients, about for us and our clients about criminal law, okay? So make sure you're here. He probably will come at 7 o'clock to avoid traffic, so he will probably come and speak from 7 to 9, just so you know, in terms of our reading for next class. A, B, and C work for the same law firm. A is the CPA who prepares both income and transfer tax returns for firm clients. B is a partner at the firm who is an expert on tax-exempt bond and rarely handles other matters. C is an experienced associate with a strong general tax background. One of C's responsibilities is to review income tax returns prepared for the firm's clients by CPAs who are employed by the firm. A prepares an income tax return for client, a long-standing client of B. C then reviews the return, who forwards it to B for transmittal to the client, who will then file the return. Who should sign the return as the signing preparer? So this is not entirely unusual. You had 3 people sort of managing. You have the rainmaker, you have the person who prepares it, you have the person who reviews it. In this, Dixie, John, what do you guys say? Any thoughts here? Who should sign this return? Kevin, you were gonna say?
Yes, I believe it should be the person who reviewed it last, because that's what he's assigned to do, to make sure that everything's in place.
So you think C, well,
C.
C,
Yes.
okay, Dixie, John? Okay, John?
Go with A as well.
I think we all agree B is sort of figurehead. B is just doing ministerial acts, right? So we can take B off the table. But if I have the fact pattern correctly, A, right, Kevin truly did prepare the return, right? So A, certainly A or C should sign the return. It's not entirely clear which, okay? And your firms, anyone who I'm sure many of you prepare returns, then you have someone who supervises you. Who signs the return, John? Your firm?
My supervisor signs the return.
Okay, your supervisor, right?
Yeah.
Right. But certainly as the reviewer, right, Kevin, is gonna have responsibility, but you as the preparer have potential exposure too. Right, so I think here you could have 2 tax return preparers. One who is signing, and whoever has primary responsibility should sign the return. That's how the regulations say, whoever is primarily responsible, this is under 7701-15B1, I'll repeat. 7701-15B1, whoever has primary responsibility should sign. But if C or A, whoever didn't sign probably has potential exposure as a non-signing tax return preparer. A, you were gonna say?
So what is the answer? A is the signing tax preparing?
A or C?
Oh.
I can't really tell you who's putting in more time, effort, and energy. Or either the 2 non-signing partners. I don't think B is a non-signing partner, but whoever, if A did significant work, even if A didn't sign, A could be a non-signing preparer. Is this arrangement satisfactory? And if you look at the model rule and section 10.36B, let's just look at 10.36B, go to Appendix A. 10.36B, any individual who has, or such individuals who have or share principal authority as described in paragraph A of this section will be subject to discipline for failing to comply with the requirements of this section. And it goes on to say, essentially, if you don't exercise oversight over the people you're supposed to, you have potential exposure. Now, the authors raised, appropriately so in the parenthetical, note that there is a serious question under current case law. What cases, guys? The two cases that follow, Loving and Ridgely. Those are the two cases that we're going to look at shortly. Does the Treasury Department have authority to regulate tax return preparation through Circular 230? And your answer to that question is, right now, no, right? They have no authority, it looks like, to they have no authority. So, what is the purpose of regulation 7701-15E? How likely is this to be enforced? I don't know if you guys both, I don't think that's in our book, but you can pull it up. You know what that regulation refers to? Essentially, this regulation, guys, if you, it's not in our book, right, guys? It's not there. But if you Google it,
7701-15.
yeah. You have it up there on your screen, John?
It's spinning on it, but
It's spinning inside.
it's not immediately pulling out.
It says tax return preparer.
Again, so B, what does it say?
Tax return preparer. Do you want me to define the signing versus non-signing?
No. Do you have 7701-15E?
E.
There's 15E.
Type it in on the Cornell website, it's 301.7.
Yeah, you gotta type, and what comes up there, John?
Tax return preparer.
Yeah. And what does it say about this particular kind of tax return preparer?
Outside United States?
Right, you have a tax, how many of you, John, what firm do you work for?
It's just a local firm on Staten Island.
Okay, who works, anyone work, Brian, you, Maury, big firms? Anyone here work for the big firm, John? No? Well, I know that many of the big firms, what do? A lot of the data entry they send to India, okay? And a lot of the returns get done in India, and then they send it 6 o'clock at night. I don't know, what time is it in India?
It's plus 10.5 hours, so it's 7:45.
In the morning.
Evening.
Evening.
What? You're saying if they send it at 6 o'clock at night, it's like an hour later in the evening?
Yeah, it's 5:30 in the morning.
Yeah.
Here.
It's in the morning, at 6 o'clock at night here is,
No, 6
4:30
o'clock in
a.m. there.
India night.
No, let's start with 6 o'clock in the evening in the US.
yes, that
It's
is
what time in
4:30
India?
a.m.
And I know India has multiple time zones, right?
Yeah, no, India has
No,
one
only
time
one,
zone.
Oh, really?
Yeah, India just has one time zone.
Yeah.
It's too big to have only one time.
It's not big, actually. It's big population-wise, but geographically, it's not big.
Okay?
Yeah.
And what time is it in
7:30.
India?
10.5 hours ahead, so it's 7:45 over there,
In the morning?
in the evening.
But it can't, are you saying it's 6 o'clock at night?
She's saying right now.
Oh, right now?
Yeah.
Oh, no, 6
No.
o'clock at night here is 4:30 a.m. over there.
Morning.
Right, that's what I
Yeah,
thought.
but then it depends on
Oh,
daylight
yes.
savings, because sometimes it's 9.5 hours ahead.
Yes, yeah.
Okay, my
Yeah.
point is that many times US practitioners at the big four regional firms can end the day at 6, 7 o'clock at night, and people in India are just getting to work,
Yeah.
can work for the next 7, 8 hours on the returns, and the practitioner gets into the office 9, 10 in the morning, and voila, got this beautiful new minted return from India.
I work for that company in India.
You work for that company?
Yes.
Okay,
But-
there's not one company, right?
No, it's
No,
so
there
many
is
company. But my firm prepared for the London, for the UK, not for the USA.
Okay, for the UK.
For the UK we prepare, but our timings, like, we have 5 categories over there. First, like, they hire 5 ways. First group is to enter the data. Second group, analyze the data. Third one, review the data. And the fourth one are the finalists who check everything is okay and then they pass to the UK. That's-
So there's a multi-step process to get this
Yes.
great return. And instead of, let's just go through the arithmetic, why this makes so much sense. You know, the person in the US is billing at, say, $600-700 an hour. The person in India is being billed at how much per hour?
20.
Rupees.
$20.
But-
At the most.
At most,
$1
20 bucks.
less than
Yeah.
$1.
No,
Less than
it's
Well,
not,
I'm
it's not
hearing-
less than $1.
Less than $1.
Depends
No.
upon, yeah.
About $20 an hour.
Yes.
Okay, about
Yeah.
20.
Yeah,
So the arithmetic,
$20?
yeah, we pay those people.
That depends on these positions. will
$1
not
an
have-
hour is.
No, that's a higher level.
They hire me around 18,000 rupees for the year.
Yeah,
18,000
20,000.
rupees for the year.
For the year?
For the year.
Oh,
For
come
just
on.
a data entry. For just a
Oh,
data
data
entry.
But for
Yeah.
those who
Doesn't
have
go
some
for-
credentials, for those who are CPAs and
They-
are
they-
working out of India, it's at least $20 an hour.
I just say they just give me approx that way that my after that one 35,000 for the year,
Uh-huh.
and for the upper part they want it's 80,000 for the year. That's it.
And 80,000 rupees per
Whole
year
year.
for guys is about
Third
$1,000,
position.
$1,200, yeah.
That is very
What,
low, but.
for the year?
So the salary is about $1,200 a year for a tax professional in India.
No,
$1,200 a year.
No, she's
you
telling
don't mean
that
1,200 a
entry,
year,
yeah.
because now I'm getting
No.
scared, because that's $100 a month.
Yeah,
No, that is not.
that's what she's saying.
No, that is data entry.
Data entry.
That's why I said it's depends.
It
There
depends,
is
yeah.
sections, data entry, you don't need the qualification for CPA.
Right.
So-
So a CPA in
Yeah.
India
20.
makes approximately how much?
$20 an hour.
20,000 a year.
$20 an hour, which is 40,000 a year,
Okay.
yeah.
So that gets back to the issue of economically, does this make sense? And the answer is hell yes. And that's why, Viva, you and other people were kept very busy in India, correct?
Not that much. As soon as the returns started coming, we just have to enter it. That's it. All the reviews part is.
No, I know, but it created all this business
Yes.
in India, and then I guess in other, Bangladesh and other countries too, because as soon as the price goes up in India, then other countries open their doors and say, hey, or Vietnam or Thailand, it's really, can I say this without exploitation of you know, sweatshops. So, and what were your hours? Did they ask you to work 12 hours a day, or?
My job was morning 7 to night, around 6 o'clock. Evening, 7 to 6.
7 to 6, 11-hour days. So, anytime you think you're having a rough year, just remind yourself, things could be much harder. All right, so the point is, can you be held accountable? What does this regulation say, V? Who has it up?
I have it.
Which one?
Well,
Yeah,
well, the regulation that they're referring to, 7701-15A.
yeah. So it says that, I mean,
E, right?
Yeah, can you just paraphrase it, someone?
Yeah, a person who prepared a return or claim for refund outside the United States is a tax return preparer, regardless of the person's nationality, residence, or the location of the person's place of business, if the person otherwise satisfies the definition of the tax return preparer.
All right, the bottom line is, in theory, then in theory, the person in India preparing the return, right, could be considered a tax return preparer. Then query though, do we really have jurisdiction over that person? So the responsibility obviously would be on the person who oversees, because there's no direct contact, my understanding is, between the taxpayer that person in India. The contact is with some, person here in the US. So even if that person doesn't do much work, that person's gonna be held accountable for the work that was done in India, the person in the US who's making the real fee. All right, so the authors, how likely is it to be enforced? Not too likely, but again, the person in charge of that person will be. And the authors then just mention about Code Section 6695, penalties that you gotta sign the return. Tax return preparer, substantive standards, okay? What are the standards here? And here, the standards, if you open up to 6694 for a second. It talks about the fact that you're subject to this penalty if you allow your clients to take unreasonable position. What's an unreasonable position? Defined in 6694. A2. In general, except as otherwise provided in this paragraph, a position is described in this paragraph unless there is or was, there you go guys, substantial authority. Everyone see it? And you can see, right, that if you lack substantial authority, then you can disclose it, right? You should disclose it. Where is that? Look at capital letter B. What about tax shelters? Now here, as opposed to with taxpayers, remember I just distributed something that was with respect to taxpayers, and that was found in the regulations. Here the statute actually gives you this third tier with respect to tax shelters. Tax shelters, and it also refers to a reportable transaction. Reportable transactions are those transactions that the IRS considers suspect. Every month, the IRS publishes a list of transactions, so-called reportable transactions that it considers suspect. You have to meet this higher standard with respect to tax shelters and so-called reportable transactions. Position described in this paragraph, unless it is reasonably that the position would be more likely than not sustained on its merits. So here's the threshold that you gotta meet if you're a tax return preparer. You have to believe, and that, by the way, can I just say that, and I've been involved in several of these tax shelters, but I'm reading through this, the complaint against the tax practitioner, and inevitably, these tax practitioners said that the tax shelters involved, and I read it last night, or not last night, well, yesterday, that it met this more likely than not standard. But you can't just say that. I mean, this is not like it's coming from the mouth of God. You can just say, even if you've been in practice for 20, 30 years, you cannot just make a declaration that is more likely than not for this to be sustained. You have to have something beyond substantial authority. And then if you do enough of these, if you do 10,000 of these, and the IRS catches wind of it, and 90% of the people, or 95%, quickly settle with the IRS, and no one litigates, that suggests that the likelihood of success is pretty abysmal, right guys? So just be careful about banning about words. I still say that the monetary penalties here are not really harsh. The bigger, like, do the arithmetic. I mean, students will sometimes say to me, Professor Sullivan, when it comes to malpractice issues, could we just be limited, capped at whatever we charged our client? Like, you get involved in a transaction and you end up billing the client $10,000, you would like to keep your liability at $10,000, but if you screw up a deal and it costs the client an extra $1 million, you're not capped at any $10,000. So these monetary penalties under 6694, that to me is not the scary part. The scary part is if this gets referred to the Office of Professional Responsibility for some reason, or as a result of your actions, you get hit with a malpractice action. So I think if if Congress wants to take this more seriously, they've got to raise the penalty threshold here. Because right now, I don't think this is having a major chilling impact. Okay, the penalty is built, which depends on, in part, the fee charged. I will call your attention footnote 28. Footnote 28 refers to the fact that even if you give a refund of your fee, that doesn't matter. It's the entire fee. It doesn't take into account any refunds. Beginning on page 66, there's a discussion of tax shelters and reportable transactions and the more likely than not standard that you're supposed to meet. And I just point out on page 67, that first paragraph there, you might gloss over, but just want to call to your attention on page 67. It says, because there is no, and I circled the word no in my book, because there is no statutory taxpayer standard for positions with respect to tax shelter item that parallels the preparer standard of 6694. So the authors are just acknowledging that taxpayers, as opposed to tax return preparers, have no equivalent standard, that there's not the symmetry that you might expect. Albeit, in the regulation I distributed, this concept of more likely than not crops up, but it's not in the statute. But then on page 67, it mentions the two other standards that you're familiar with, that being substantial authority and then reasonable basis. Okay. Just like taxpayers can avoid penalty exposure by exercising or having reasonable cause and good faith, tax return preparers can avoid penalty imposition if they can demonstrate reasonable cause and good faith. The authors do point out, though, that it's a harder burden to meet, right? Because you're supposed to be skilled and knowledgeable as a tax return preparer. So you have less excuse as a taxpayer. You have an easier excuse to say, hey, I relied on a professional. The professional doesn't have that easy excuse, so it's a harder threshold to meet. So just bear that in mind. So in problem 2-8, some of these names I have problems with. Minerva prepares income tax returns for filing or us. Commercial return preparation firm. Smith is a real estate investor. Minerva has prepared Smith's 2015 tax return for a fee of $10,000. FAU guarantees that its filings are accurate. Minerva, however, made an error, resulted in the entire fee being refunded. Let me just say, the fact it's refunded is immaterial, right? We agree? I cited you to that regulation, so not going to save the tax return preparer here. Minerva made an error on Smith's tax return that resulted in the entire fee being refunded. Minerva spent 3 weeks of her 50-week year preparing the return. Her annual fee is $50,000. Assuming the IRS determines both she and the firm should be penalized under 6694, how will each of them be fined? your answer would be the same if the fee had not been refunded. Is there something wrong? So, could you guys take 3 minutes and compute the penalty here? Because, right, Brian, we know that knowing the penalty amount is useful for taxpayers, and it's going to be useful to tax return preparers. So let me keep my mouth shut. Let me give you a site, and this you may find helpful. If you go to Regulation 6694-1F4, example 4, let me repeat. 6694-1F4, example 4. I gave you, or I sent to you through Blackboard, the regulations under 6694. You'll probably find it there. I don't think it's in your book. I'll repeat it one more time. 6694-1F4, example 4. And then take 2 minutes, try to come up with a number. Anyone come up with a number before? Anyone have a number? All right, so take 2 minutes and try to come up with a number. Let's start with the easy part. What's the total penalty here, guys? Have a number? Mike, you have a number? Just a total number.
15,000?
How much?
15,000?
1,500? Bing? How much?
Maximum is a 5,000.
5,000, Ming, do you agree? What's your authority for that?
5,000 or 75%.
Well, what is he? Is this understatement due to willful or reckless conduct, guys? Probably not. So we're probably under the normal penalty. Right? What's the normal penalty, guys? $2,000?
Or 50% of income.
Okay, it's the greater of, right?
Yeah.
Greater of $1,000 or 50% of the income. What's 50% of the income?
5,000.
Okay, 50% of 10,000 or 5,000, right? Last I checked, 5,000 is more than 1,000, right? So the penalty here is going to be 5,000. Everyone agree? The fact that there's a refund, we already said, is immaterial. Agreed? Now, how is it bifurcated between the two? Now this regulation, again, I sent you on Blackboard all these regulations, so, but you can pull it up off the internet, guys. You don't need me for this. Goes through it. I mean, the authors were not original, guys. The authors took this straight hook, line, and sinker from the regulations. Okay? And how would you compute the penalty here? Well, how much did our Minerva, what proportion of the 50,000 she earned was attributable to preparing this?
3 weeks.
Okay, 3 weeks. So 3 weeks out of 50 is what percent? What percent is 3 out of 50, guys? 6%, right? So how much did she earn theoretically on this? How much?
1,500?
Did she?
Oh, right, 3,000, I'm sorry.
3,000, right?
Yeah.
She earned 3,000. 6% of 50,000 is 3,000, right? Everyone agree? Everyone see where we got the 6%? That's 3 over 50. 3 over 50 times her 50,000 salary, or 3,000. So her penalty is going to be 1,500, right? Right? And then what ends up happening is the firm ends up paying 3,500, whatever the difference is. Everyone can do this? Everyone's good? Everyone see where that? If you don't, just take a 5-minute look at that regulation I cited you to. The authors just copied and pasted it, just changed some of the numbers. 2-9. On a highly technical tax issue attributable to the tax shelter, 2 lawyers in the same firm both disagree on a reporting position that affects 2 unrelated clients' returns. Both lawyers are well qualified, recognized experts in the area of tax law. Lawyer A believes that it's more likely than not that the type of transaction qualifies for non-recognition. Lawyer B, on the other hand, believes that it's more likely than not the type of transaction is taxable. Both lawyers' arguments for their respective positions are well reasoned. Assuming the lawyers are signing preparers for their respective clients, and they sign returns on behalf of the firm with contrary positions for the respective clients. Let's pause for a moment. Everyone understand that, and this could happen in an accounting firm. You have a law firm or an accounting firm, and you have 2 different people, 2 different corner office people, I'll say metaphorically, who arrive at different conclusions pertaining to a tax shelter. You're in charge of the firm. Would you allow them each to take these contrary positions. They're unrelated clients. So what do you guys say? Kevin, doable or not? Go with your instinct.
If they had different outcomes, then I wouldn't allow it.
You wouldn't allow it.
No.
Ryan, what do you say?
I think they can.
You think they can?
Yeah.
When you say they, remember, we have partner A, partner B, and a firm. So be careful because the word they. Are you referring to A, B, and then the firm? That this is kosher at all three of those levels.
Yeah.
Maury?
I would say yes, disclosure.
Remember, where does disclosure get you here? Disclosure to whom? Be careful about, all I'm suggesting too is be careful about banning about words. I'm not saying you're wrong, I'm just saying, who are you gonna disclose what to?
To the client, so aren't you saying that the clients are getting two different opinions from the same firm?
You gotta be careful. First of all, we're gonna get into client confidentiality, right? So you gotta be careful about what you're gonna say to your clients. And I'm not saying you can't do it anonymously, like, hey, we have another client, I want you to be sensitive to client confidences, right? Because that's important, you can lose your license if you don't. And we're gonna look at some conflicts of interest are waivable and some aren't. Let me draw your attention to a non-waivable conflict. I, as an attorney, cannot represent two people on a prenuptial agreement and represent a husband and wife. That is a non-waivable conflict, right? It is impossible for an attorney to simultaneously represent a husband and wife on a prenuptial agreement and give them good disinterested advice. Everyone agree? Can't happen. By contrast, I've done plenty of wills for people from second marriages, right, that have a conflict of interest, but that's a waivable conflict of interest, right? Where if I make full disclosure and I tell them that, you know, my advocacy will be somewhat limited, they can say, that's okay, there's economies of scale of you representing both of us. So that's a waivable conflict. So anyway, these are concepts. We're going to go into more detail. Just giving a little bit of preliminary. I mean, keep in mind, why are you here on a Saturday morning, guys? And why are you taking this course instead of just the general ethics course? I mean, the purpose of this course is to make sure you don't get into trouble ethically, which, as I said to you, or that you don't get sued, or that you don't get penalized. As practitioners, is that these are all the ethical dimensions you have to take into account when you're practicing. I'm trying to sensitize you to that because a lot of practitioners haven't gone through this, and they can, hopefully you guys will be more sensitive to these issues. Anyway, that was a long digression. I'm not sure of that disclosure here, I'm not sure where that gets you, truly. Anyone have any other ideas? If there's a tax shelter involved, and you...
The two attorneys know that they have?
They know they do. And then keep in mind that many times, I don't know, depends on the size of your firm, many firms to issue opinion letters, they have to go through a committee. So there's no, and nor should there be secrets in a firm, right? The firm as a whole, the members should know what everyone's doing. Sometimes it's very hard to do that. But when they issue opinion letters, often there's a committee to give final, so that things don't, you don't want a rogue practitioner, right? Who just writes an opinion letter. And remember, your firm can be sued and destroyed by one practitioner, right? One bad apple can destroy any one firm, right, guys? You can't just say, oh, he did it all wrong, and preserve your firm. I mean, big firms have gone by the wayside because it just takes one bad player. So there is some oversight, typically, where they will know about each other. So where does that leave you? can this firm issue this opinion letter that takes contrary positions? And the author's point as we read through the questions, because sometimes by reading ahead, you get a taste they're gonna distinguish this from the other fact patterns. This is problematic, right? Because more likely than not, suggests there's a greater than 51%. So it suggests that one of these two people is likely to be wrong, right?
So it depends if you're a betting man or a hedging man. Are you going to
Well,
choose both or swing for the fences?
I think it puts you in this firm, if you're firm management, say, we can't do this. We have to, one of these two positions is right, we'll let that happen. The other one, we can't have our firm name, because at the end of the day, that if the government has this, they can possibly use it as a tool. And where's your credibility if you get up trying to protect your client and say, oh, we thought it was more likely than not, and the government says, oh, here's your firm letterhead on this other one saying it isn't.
So create two sub-firms that are separate C corps?
Maybe, no, with the common ownership, you're gonna have a problem. No, so
It's
don't,
also not-
don't be.
Conflict in general?
I mean, a conflict by its very nature, by the same firm, embracing two contrary positions and saying each is more likely than not, right? Think on the face of that. I don't want to be part of that firm. So you're really running the risk. Kevin, you were gonna say something?
It's like flipping a coin. It's like you have to take one or the other if you were to do that.
Hopefully it's more reasoned than just flipping a coin, but
Yeah.
I get your analogy, type thing, all right? Okay. Question B. Lawyer A and lawyer B are members of two different firms but represent the same client. Both lawyers are well qualified, recognized experts in the area of the tax law. Lawyer A has provided the client with a written opinion to the effect that a reporting position with respect to tax shelter satisfies the more likely than not standard. Lawyer B, in preparing the client's tax return, is preparing the client's tax return, excuse me. Client provides lawyer A's opinion to lawyer B, who does not agree that the position satisfies the more likely than not standard. Can lawyer B prepare the return treating the item as non-taxable without disclosure and without advising the client about penalty exposure, relying on lawyer A's more likely than not opinion? I'd say good. Martin? What do you need to avoid the penalty as a tax return preparer when it comes to tax shelters? Just take a step back before you say anything. Can this tax return preparer rely on this other lawyer?
Yes.
I hear a yes. But keep in mind the standard here. To avoid the penalty as a tax practitioner under 6694, you have to believe the position is more likely than not sustainable on the merit. Do you?
Yes,
Well, if you're lawyer B, you don't though, right? If you're preparing the return, lawyer A does, lawyer B who's preparing the return doesn't. But can you rely on lawyer A and avoid the penalty? Do you see what's going on here, Ping? Lawyer A writes his fancy opinion letter saying it's more likely than not. Works at a different firm. And the client brings it to you and says, prepare the return. But you don't think it does. You think it doesn't. You still prepare the return and avoid the penalty.
No.
Again, guys, I handed this out. This is regulation 6694-2E5. This, again, when I say handed out, I sent it by Blackboard. 6694-2E5. It talks about reliance on advice of others. It's a, I'm sorry?
No unreasonable assumptions.
It's 6694-2, not -1, -2E5. It talks about reliance on advice of others. And it talks in the middle there that the tax return preparer, in this case B, may rely in good faith on the advice of or schedules or other documents prepared by the taxpayer, another advisor, another tax return preparer, okay, or other party who the tax return preparer had reason to believe was competent to render the advice or other information. So, if, laconic if taxpayer B truly believes, excuse me, not taxpayer, lawyer B, practitioner B, truly believes practitioner A is a skilled advisor, probably you could rely on taxpayer, on practitioner A, I should say. So I'm not trying to make your notes ambiguous, but it seems to me, based on that regulation, that you probably could avoid penalty imposition. I'm not categorically sure, but it looks on the face like you could.
If you believe in it.
If you truly believe.
So he doesn't, so that would be no.
You know, it's not clear once he reads it, how do the authors frame it? Lawyer B who does not agree with the position. So lawyer B can get into hot water. It's not clear, it's not entirely clear how this is written. Right? I'm sorry, B, but you were gonna say something?
Sorry, which regulation did you just now
This is 6694-2E5.
2E5.
Right. I can say this, Kevin, if it makes you feel better, makes me feel better. If we look at problem C, that one I think we can all agree. The same facts as A above, except the issue does not involve a tax shelter or reportable transaction. And lawyer A concludes that a non-recognition treatment is supported by substantial authority, while lawyer B believes that the tax treatment is supported by believes taxable treatment, not non-taxable. Taxable treatment is supported by substantial authority. Can they sign returns on behalf of the firm with contrary undisclosed positions? And you guys say yes.
So the other one, it doesn't, because he doesn't agree to the lawyer A. So
Question
that-
B, I think, is a hard one, Dixie, could go either way.
Oh,
Okay?
yeah. So my question is that the question is clearly stating that lawyer B who does not agree, that shows he's not,
He doesn't have a good fit,
faith in him.
Yeah,
So
it would be
that's-
harder for him to meet the standard under 6694. But question C, I think we can all agree, this would be permissible. This would be permissible. 70. If a preparer is unable, after a reasonable amount of research and analysis, to determine whether she believes the position is, a position attributable to the tax shelter is more likely than not to be sustained on the merits, can she advise the taxpayer to take the position on the return without risking penalty under 6694? If not, how should the preparer advise the client to report the item attributable to a tax shelter on his return? So can the tax return preparer advocate this position? Ming, what do you think? Can the tax return preparer advocate this position? Not sure? B, you were gonna say?
Me? I don't think that this position should be advocated.
The tax return preparer cannot, right? Because tax return preparer has to believe, right? It's more likely than not. Agreed? To sign off on the return. However, what can he say to the taxpayer? And this is where the regulation that I distributed comes in, right? This is 6662-4G. 6662-4G. So this says that you can advocate to the taxpayer to take this return position only if the taxpayer has substantial authority, okay? The taxpayer has substantial authority, and the taxpayer reasonably believed at the time the return was filed, the tax treatment of the item was more likely than not the proper treatment. And you're supposed to contemporaneously document that you told the client that. You're supposed to, and if you look on page 67, and you look at the first full paragraph there, right in the middle of that first full paragraph, it says, interim guidance provides that for purposes of 6694, position with respect to tax shelter will not be deemed unreasonable if the preparer advises the taxpayer the two-part regulatory standard and that disclosure will not protect the taxpayer from assessment of penalty under 6662. Both parts of the standard are not satisfied, and contemporaneously documents this advice in the preparer's files. All right, so that's what you're supposed to do as the tax return preparer, right? And it comes down to, if you look at the citation, notice 2009-5. Column 2-11. Client sold an asset in 2012 in exchange for a note payable over 5 years. That's right. Sounds as the owner of an installment sale under Code Section 453, right? Does it qualify? Although the treatment of the sale as an installment sale was not supported by substantial authority, but it did reach, or didn't meet the reasonable basis standard, preparer acts nevertheless prepared the taxpayer's income tax return in accordance with the installment sale rules in 2012, 2013, and 2014, without disclosing the position, perhaps out of ignorance at the time. So keep in mind, it didn't meet the higher threshold, right? It meant that it wasn't frivolous, it meant this reasonable basis. But if you have a reasonable basis without substantial authority, you're supposed to make disclosure. Everyone agree? In preparing the client's 2015 calendar year tax return, is Preparer X required to prepare a disclosure with respect to the treatment of the portion of the gain reported on the 2015 return? So, and we will all, if you guys practice, if you don't mind me saying, unless you lack the human condition of making mistakes, you will make mistakes, and you will discover your own mistakes. Those are tough days in the office. When you discover a mistake of yours, it's always easier to discover others' mistakes, right? But sometimes you discover your own mistakes. What do you do? Aside from shut the door and cry a little bit. When you say disclose, what is that? I'm gonna say the same thing. What does the word just disclose mean?
No, you have to send a letter to, you know, if it's related to the tax return, you
What?
notice to the.
Talk to me. You come to I'm your supervisor, just talk to me. What are you gonna say?
Yeah, mistake.
I made a mistake.
I made a mistake.
Correct.
I made a mistake. I can't.
Say again, Dixie?
Is that true? Like, I feel like I found a mistake, so.
You found a mistake, and then you say, I feel terrible. Keep going. What do you say?
Considering getting a
Correct.
PhD.
Correct the mistake. What does that mean, correct the mistake?
And then,
Amend, yeah.
Oh, yeah.
Amendment.
Yeah.
And what does that mean?
What is the further procedure or how I can?
Okay, what do you do?
Yeah.
Because what do you think you're gonna do with your supervisor? You found a mistake, you've been doing these returns for the last 4 or 5 years. What do you do?
Ask your supervisor to inform the client.
You gotta inform the client,
And
okay? And
if the client doesn't wanna amend,
what do you do?
document it.
Right, I mean, what you have to do is come up with a strategy, and you gotta be very, very diplomatic about this, right, guys? And look, I've spoken to lots of people at KPMG, and the big, the fact they're big firms doesn't mean that they're immune from not making mistakes, right, guys? And their policy, when I say they, I know specifically at KPMG, they will prepare the returns, needless to say, free of charge. You wanna really irk a client, make a mistake, and then say, oh, we won't bill you as much to correct the mistake. Can't do that, but thank you. You gotta make sure that you make this as painless as possible for your client, right? So, and at the end of the day, when it comes to amended returns, the regulations under 451 say that the client may file amended returns. It does not use the word shall. Big difference, right? So when it comes to making or taking corrective actions, the client's under no legal obligation to change it. In fact, the client has an incentive, right, not to change it if it's in the client's favor, because if the client gets penalized, who's gonna bear the, I mean, you can, in my opinion, mitigate your damages, because one of you mentioned you should recommend the client to amend the return. If the client doesn't at that point, in my opinion, anything going forward is on the client's back. But they still may try to play audit roulette and not submit a return and say, well, let's just see what happens. But at least you can possibly mitigate some of the damages if and when things hit the fan. So In response to 2-11, you're supposed to, correct your errors and, again, advise the client. Circular 230 10.21 says you're supposed to let the client know of prior errors. The SSTS in the back of your book, which deals with the standard procedures of tax services for accountants, you're supposed to, again, let your clients know if you've made mistakes. One of the Blackboard articles I sent you, I sent you 2 articles. One was with Michael Lang and one that from several years ago that this class I was inspired to write, dealt with correcting prior mistakes. So if you want to see my version of what to do, you can read my article. And I wrote that many years ago, but just to give you a taste of where I'm coming from. Question B? Same facts as A, except the preparer Y, another preparer, was neither affiliated nor knows of preparer X, is preparing client's 2015 return. Preparer Y receives copies of the earlier returns from client that otherwise knows nothing about the 2012 transaction. May preparer Y rely on the earlier returns to continue reporting the gain from the transaction on the installment method on the 2015 return. So picture, if you will, you inherit a new client, and when you get that client, you see the prior accountant has been reporting the transaction on the installment sale, right? Installment method, I should say. Can you continue to rely on the work of the prior accountant and just, you know, keep that going? V, I see you're nodding.
Yeah.
I think you're nodding. Hopefully not nodding asleep, but
No.
nodding.
Nodding.
Okay, and why?
Why, I
Yes,
don't have
Radar.
authority for that, but, it just seems intuitive that you can rely on it, and to actually have to go through it all over again, you would have to charge the client for all those years, and no client would be happy paying for that, so you just have to rely and take it as true.
Truth of the cup, and that, as my kids would say, and that's the T. That's the line I keep getting back at home. 6694-1E2, I'll repeat, 6694-1E2. And again, guys, you know, what I sent you on Blackboard is only 2 or 3 pages, each one of these sites. They're not in your book. Okay, your bridge regulation, code and regulation book can't have it all. If you look, it's entitled Verification of Information on Previously Filed Returns. Okay? Verification of information on previously filed returns. You got it? And just like B was suggesting, you do not have to go beyond, if the information looks right, there's no reason that you have to go through it a second time. And the other reason, aside from the fact that these regulations are really spelled out, the responsibilities, let me just remind you, they have a series of examples. They're very easy to follow, so you should look through these examples because they're easy to follow, and they're not hard at all, and they will put your mind to rest about some of the parameters of your responsibility. So do look at these regulations. I think you'll find them comforting. So question B, the answer is yes, that you can rely. And question C says same facts as B, except that preparer Y's review of the earlier returns leads her to suspect the transaction was not eligible for the installment sale. So for whatever reason, looking through the returns, it doesn't seem like it's eligible. So in this case, can you rely? Mike, what do you think? What's your gut? No, right? And the regulations makes clear that if the information seems flawed in any respect, regulation 6694-E-1E2, let me repeat, 6694-1E2. Okay? Sensible rule. 2-12. F is a lawyer who has prepared client's federal income tax return for many years, preparing a client's 2015 return. F notices that client did not provide a Form 1099 INT from a bank which had produced significant interest income in prior years, including 2014. F does not ask client about the missing form, prepares the return without reporting any interest income. The return is prepared by, the return is filed as prepared by F. A couple of years later, when F is under IRS audit, it becomes clear that the client did receive a large amount of interest from the bank, leading to a substantial understatement under 6662, right? Client had to pay taxpayer had to pay a 20% penalty. What are the possible consequences to F of this understatement? So, is there potential 6694 exposure here, guys?
Two ways it will be done. Either he can suggest the client to amend the tax return.
Fine, but no, you can't. Been there, that train left the station because they're already under IRS audit. And the IRS is assessed a penalty, right? So the question is, does the tax return preparer have potential penalty exposure here under 6694?
Have to do with, understatement principle for workers.
Okay, so your inclination is, hey, this tax return preparer did not do his or her due diligence, right? They should have.
I think it says that they noticed,
He noticed
and then he didn't,
Right.
so.
He intentionally left it out, so therefore he should be liable.
Yeah, he has exposure, or she has exposure here under 6694 because didn't take proper precautions. And most firms, right? John, you work at a smaller firm, right?
Yeah.
With your clients, do you have a checklist that they're supposed to sign off on?
They fill out a checklist, yeah.
And Viva, you too? How long is your checklist? How many pages?
It's like 8.
I have one.
You have one page?
Only one page.
And you have 8 or 9?
It's like, yeah, it's probably close to that.
Hey, John, I don't know if this is proprietary. Would you be able to send me that? And Viva, could you send me yours?
Yeah.
If you could, I'll see about circulating it to everyone.
Okay.
These are common devices that accounting firms have to ensure that taxpayers take some responsibility for what's on the return. So if anyone prepared tax returns and not use these questionnaires?
If the new client is coming, like suppose he didn't file tax return before with our firm, so we can ask them the last year's tax return copy. So
Right.
it will in the checklist. If you are not first time over here, you can ask. That's the one common line from us.
Someone
We will ask.
really
We will.
John, you were gonna say? I'm sorry, I'm just curious.
No, she asked me if that's like the tax organizer, but I said I guess it's kind of similar.
It's, all right, I mean, every firm has their own procedures, some are more detailed than others. Some of the malpractice cases I've been involved in with professionals, questionnaire never got filed, and then taxpayer, one case in particular, lost a big opportunity where the firm mischaracterized something as a passive loss that wasn't really passive, and the questionnaire would have helped. So these things are important to get done, and make sure you keep the records. I'm assuming, let me not assume, but your firm, everyone scans in their documents and then tosses the original. Is that a fair statement? Right, Viva, or John, you keep it. You just have scanned versions, right?
The past few years, yeah.
Past few years, and then what do? What kind of backup, do you have it like in 2 or 3 different places in case something gets corrupted?
We have like an IT team that like backs it up every hour.
Okay. I'm assuming there's multiple places. And,
like business continuity?
well, just in case things fall apart, you wanna make sure that you haven't lost your records for the last 10 years.
We are keeping in the cloud, but like I'm also looking for IT guy to help me for that process. We have it the backup, but we want to do on the cloud right now because that's easy.
Right. These are all things that in the year 2019 you have to be sensitive to.
So going on that like missing 1099 situation there, say for example this account you didn't know existed, like something you just inherited, you moved multiple times, they had no accurate address on you, and then one day out of the blue you discover said account. Do you get assessed penalties and interest you never knew the account?
I mean, you don't, the taxpayer is the 6662.
No, you and the taxpayer had no, like say it's an inherited account that they never knew they inherited.
Okay.
And over the years, it can come out dividends.
I think then each side has reasonable cause.
So they obviously would just amend, pay it properly,
Yeah.
but they're not gonna get
Right,
whacked.
they should not get whacked.
Right, that's beyond their control kind of thing.
Right. Same facts as A, except that F asked the client whether she had other interest income, and the client responded by providing Form 1089 INT from another bank, but did not provide one from a bank. What possible tax consequences to F in this situation? So, John, does this scenario, do you have any, is this a better or worse fact pattern for the practitioner?
Just when the client did not provide information.
Right.
Taxpayers,
This is better or worse? Brian, you were gonna say?
I mean, I think it's slightly better, but I think they should still follow up and say, you had this amount last year, you have this 1099.
Okay, I mean, I agree with you, but this puts the client in, the tax return preparer, let's identify who's at stake here. This fact pattern puts the tax return preparer in a slightly better situation where they did ask, hey, do you have any other returns? And there's an example directly on point which absolves the tax return preparer in this kind of situation. The regulatory site is as follows. 6694-1E3 example 2. Again, the regulatory site is 6694-1E3 example 2. Good? All right.
So, one time happened with me, like one client is old, he's so much old, he cannot explain his, whatever the tax return with me. So I just found it that he has capital losses from the previous year. So I asked him, do you know about this? And he said, no, I don't know anything about this. Then I told him, can I talk to your previous account, CPA? So
Right.
he refused me, he cannot talk to you this thing.
So Viva's saying she had a capital loss carry forward under code section 1212, right, Viva?
Yes.
Where recall that you only can take up to $3,000 of capital losses each year, and she sees on her client's return, an elderly client, right?
Yes, so much, he don't know anything about this thing.
Okay, that, and has, maybe 100,000 in capital losses, and can you just keep carrying them forward and using them against capital gains? Is that your question?
But I think he don't know anything this one, but I.
What do you mean he? Be careful.
The
Who's-
client.
Doesn't know.
Actually, he always filed tax return, just, I asked him to bring the previous tax return copy because he was. my
Sure,
first
you
one.
have to.
So he bring it to me, I just checked the return and he has it carry forward losses. So I I just asked him, do you have, how much loss you have it, previous. So he didn't tell me proper answer because he told me I don't know anything. My accountant or my CPA knows. So I just asked him, can I talk to your CPA so he can guide me further? He refused to give me his number or anything. So in this situation, I just talked to my CPA and he told me that you can take whatever he has lost from the previous and then you can follow. You don't have to talk.
Yeah, I mean, the regulatory sites say in this kind of situation, if the client refuses to allow you to talk to their prior professionals, but they say this number is accurate or, you know, they stand by it, I don't think you're gonna have any penalty exposure. And as long as you document, spoke to client, tried to reach prior tax professional, client refused, you've done your due diligence, nothing more. But document it, because if you don't, and something comes to life, you can have your own issues, okay? So just don't assume anything, assume the worst, okay? People tell you, and when we talk in a few weeks about malpractice issues, people who've had very close relationships with their clients, doesn't matter, okay? And people will sue you, and you'll be like, I thought we were friends. And they'll say, this is business. We are friends. This is just business. All right? I mean, they...
Want to go get a drink after the deposition?
They will, you know, strange... A friend of mine was being sued by another attorney, and they saw each other at a social event, and the guy came over to my friend. I think I would have been more gracious, but when the guy said, oh, you know, making small talk about... My friend said, look, we can't have this conversation, so just walked away. So people see it different dimensions. All right. Now, I maybe mentally am consumed, and that's in part why I wrote the article that I sent to you about people making mistakes, because, you know, I do think that's the human condition. So I'm always curious about mistakes and their consequences. And, you know, in those situations where clients, and clients are apt to potentially reject advice on return positions that you think are flawed. So what do you do in those circumstances where a client rejects your advice? All right? And on page 72, there's a discussion about the AICPA, SSTS, the standards that have to be met. You guys can read this about situations where at some point you may consider getting rid of particular clients, right? Because sometimes clients who are apt to reject your advice, they're probably not going to be good clients in the short and long term. So, and I say this from a position of privilege, I guess, because when you're young and hungry, you do things that when you have a little bit more of established practice, you're a little bit savvier and wiser. And I'll give you a perfect example of this. About 3 years ago, I got a call from a child, a son, saying, my father's at which hospital down in Islip, and he's unfortunately dying. Can you run down there? He doesn't have a will. Can you run down there and do a will? And I said, I think I can, but just tell me, do you have any siblings? Yes, I have one sibling. I said, well, to whom is your father leaving his assets? And the son said, all to me. I said, well, I can't do that well, okay? I can't do that well. But guess what happened? About a year later, I get a phone call. Would I be available for a deposition? Because the attorney who drafted the will, and I never met the attorney who drafted the will, was now being sued, okay? And I'm sure it was a younger version of myself. Because my younger version of myself probably would have said, oh, I can run down and I gotta get a new client and it will be business. So I empathize with you guys in your younger stage of your career, because you may not have the luxury or think you do of turning down business, but the best advice I can, there are some things that you know no good will happen. And it's just, you gotta be able to say no. And it's gonna be tough because you're gonna say, hey, new clients are very hard to come by. So it's not in your comfort zone to say no, because, but I am telling you, it is never gonna be worth putting yourself out there. So heed my advice, please. I will save you a lot of emotional turmoil. If you, there's just some bad apples that you know you don't want. The authors on page 77, 74, 75 talk about due diligence and care. These are the things at the very bottom of page 74 that we've seen. At the very last sentence, complete sentence, is in gathering information on that page, the preparer may in good faith without verification rely on information provided by the taxpayer. Okay, this is, and it cites the regulations under 6694-1E1, and Viva's point is she was relying on that. But on page 75, the second line down, it says, however, the preparer cannot rely on information that appears on his face or from other effects known to the preparer to be incorrect, incomplete, or inconsistent. Okay, so, you know, it's not carte blanche, right? There's limitations on what you can rely upon. So, bearing all those things in mind, why don't we do this? It's about 10:30 bewitching hour. Our goal is take a 15-minute break. V was kind enough, V, can you tell for members of the crowd, what kind of, this is not any oatmeal, this is special oatmeal. This is, what kind of oatmeal is this, V?
It's I slow cooked steel cut oats.
And this is the kind of oats that really, your ribs, holds right onto the ribs, okay? And what flavor are they?
Apple, cranberry, and cinnamon.
Okay, so no one will go hungry today. It is not donuts, so we're taking it up a notch in terms of health levels. And when we get back, we will finish chapter 2. If anyone wants to volunteer next week as a communal effort next Saturday, if anyone, over the years I have found several of my students beyond, they bring a cooking expertise or an ethnicity of the kind of food that they want to share with the class. So let me not stop you. If anyone wants to send me an email about the kind of food that you'd like to share, we can dine next week on something a little bit different than oatmeal. But anyway, let me stop here. Take our 15-minute break, and then we'll pick up and we'll finish this, and we'll two cases that we will look at: the Loving case and the Ridgely case, which are going to be really important for our use in the class.